Now we are going to talk about how to scale in a trade. There are two different ways of scaling in. One is when the market is moving against you, and the other is when the market is moving in your favor. Let's start off by talking about adding to your positions when your trade is going against you. You may be thinking, why on earth would I add more to my losing position? Wouldn't I just lose even more? This can be risky and we don't suggest it to new traders. But if you're able to add to a losing position and still be within your rules of risk management, then this will be okay to do. Let me explain how this works and start with the rules that must be followed so that this is done safely. First of all, a stop loss is necessary and must be followed. Second, the levels at which you are going to enter need to be predetermined before entering any trades. And third, all lot sizes must be calculated beforehand so that the total risk of all of the trades combined is still within your risk comfort level. All right, let's just look at an easy example of how this is done and how this could be a beneficial strategy for you. In this chart, you can see the prices over here. We can see that it started up here at 1.2300 and moved all the way down here to 1.1900. And then you can see here that it consolidated for a little bit between 1.1900 and 1.2000. And then after that, it broke even lower down here to 1.1700. And that now what's happened is the pair is retraced again up to this level. Now, let's say that you think the pair will turn back and keep heading down, but you aren't sure exactly when the turning point is going to be. There are a few different ways to approach this trade. The first entry option is to go short at the price level of 1.1900. This, as you can see, was the bottom of the past consolidation area and is a broken support level that could now have turned into resistance. The only downside is that if the market breaks past this level and moves even higher, you could have gotten in at a better price. Entry option number 2 is to wait until the pair reaches the top of the consolidation area and to go short at this price level of 1.2000. This is potentially a really strong resistance level. The only problem with this is that you run the risk of the market not getting all the way up here before turning and dropping back down, and you would miss out completely on the opportunity. Entry option number 3 would be a little bit more conservative, and you could wait for the market to come up to the 1.1900 price level at this resistance level and enter a sell trade once it bounces off of that resistance level. This is a good move because this is confirmation that the sellers are back in control before you enter. But of course, you would miss out on getting in at a better price. So which option do you choose? Should you get in right here at this price level or up here at this price level? Why not both? You can actually enter in on both as long as you have your plan written out beforehand. Let's go through how you would write out that plan. First of all, you want to determine the point of invalidation, or in other words, where you would put your stop loss. In this example, let's choose 1.2100, since if the market goes all the way up here and reaches this point, it is broken past both resistance lines and is probably not a valid trade anymore. So that is where you would exit your trade and place your stop loss. Next, you want to determine where you are going to enter. There was support or resistance here at these two lines at the levels of 1.1900 and 1.2000. So these are good levels to put pending orders in. In this case, it would be 2 sell limits because once the price gets up to that point, we want it to place a sell trade. And once it gets up here, we want it to place a sell trade. So after knowing that you want a pending sell limit here and one here as well, and your stop loss up here, now we can determine the lot size on these two trades. So let's say you have an account of $5,000 and you only want to risk 2% total. That would mean on this trade, you would be willing to risk $100. So now that you know how much you want to risk on this trade and you know where the pending orders and the stop loss should be, you want to set everything up. Here's one way to do it for this example. You could have one sell limit be 2,500 units and the other sell limit be 5,000 units. 2,500 units is 0.025 for a lot size, and 5,000 would be 0.05 for a lot size. So 2,500 units of the Euro USD means your value per pip movement is 25 cents. With your stop loss up here at 1.2100, you have a 200 pip stop on this position, and if it hits your stop loss, that is a $50 loss on this trade. We found that out by multiplying the 25 cents by the 200 pips, and that would give us $50. Then on this trade, 5,000 units or 0.05 lot size of the Euro USD means your value per pip movement is 50 cents. With your stop loss up here at 1.2100, you have a 100 pip stop loss on this position, and if it hits your stop loss, that means that you would lose $50. That's calculated by multiplying the 50 cents on this trade by the 100 pips for the stop loss, which would be $50 that you could lose on that trade. So with this trade with the max risk of $50 that you could lose, and this trade with also the max risk of $50, you have a total of $100 that you're risking between these two trades. By doing this, we've created a scenario to be able to enter in at both positions and still only risk 2% of our account. If the market only goes up here to the 1.1900 position, it's going to trigger this sell stop, and we're going to at least get into this trade at a 0.025 lot size. That would mean that we got in a great position on this trade. And if the market goes all the way up here to the 1.2000 price, it'll trigger our sell stop here, and we'll get into a trade at this price. Then since the bulk of our position is here at this price, the Euro USD doesn't have to fall too far from the resistance area to make a good profit. So this is an example of how you can scale in trades. In the next section, we're going to talk about one other way to do this.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.